Hello and welcome to Long Verticals and Diagonals. My name is James Boyd. We welcome you here today. I think Ben Watson normally teaches this class, but he flew down to Orlando for the workshop. So that's why I'm covering his class. I believe it's his class. And we also have Michael Fairborn in the chat. And yes, since Josh is here, we can get started. We're having a little fun with Josh. And Josh, you've been such a great sport lately, playing around with you a little bit there in the chat. Now, one thing you'll notice is, yes, we're going to learn about option strategy of long verticals, right? We're going to compare it today to a long call. We're going to compare it today to a collar. I really want to kind of have a focus on delta, theta, and vega, and really kind of talk about the differences in the strategy and how that relates to the Greeks. I think a lot of times when I look at different option strategies, I kind of wondered if it was like a sales pitch to do different strategies, or was there really merit to different strategies and why you would pick them, okay? So I want to talk about this strategy of a long vertical, really look at the option Greeks and compare, contrast it to a long call and a caller. Now, just real quick as we get started here today, you could follow us on X. We post frequently on X. So my handle is at James Boyd CS, capital J, capital B, no other way. If someone reaches out talking about some type of thing they're trying to pitch, they are James Boyd wannabe, okay? It's not me. I don't reach out and pitch anything. Okay, Michael Fairborn, you can put your handle in there as well. He posts great things there on his X page as well. So follow us. We post education content and also some things that comes across our desk we think are interesting, which I'll show you in just a sec, and we will share back with you. So just real quick, remember that options carry high level risk, not suitable for all investors. We'll talk about what some of those risks are here today. Remember, the information provided here is for general informational purposes only. And also remember that investing involves risk, including loss of principal. Now, also remember when we talk about options, we're talking about probability analysis, and understand that there's certain kind of the math behind the strategy. We want to get an idea of how does that really work. So I talked about really what we're going to really be looking at today before. And what I'm going to do now is let me kind of bring something up. And what I want to do is I want to bring up for just a moment a long call vertical. Let's just kind of get our feet set, okay? And I want to go back to this trade for just a moment, okay? Now, in the last couple weeks, we know that there's been a big push towards travel. You look at Booking, BKNG. You look at Expedia, EXPE. You look at Royal Caribbean, RCL, CCL, NCLH, and so on and so on and so on, and Marriott, and you name it, there's been a big travel push, okay? Now, one of the stocks, now, by the way, when you look at also some of these airlines, UAL has exploded to the upside. You look at, and by the way, I've never seen it do that, not to this magnitude, and it's been bananas, okay? When you look at, let's say, Delta has had a pretty good push and a little pop here today, and you look at Little Love, we played Love kind of from the perspective of could it maybe more go in line with what the other airline stocks were doing. It's done okay, but it ain't UAL. Now, let's kind of first, so that's kind of the space I'm talking about right now. And I want to kind of look at this trade for just a moment, okay? Now, when someone does a long call vertical, why are they doing a long call vertical? Why? Why are they doing it? Why aren't they just buying shares? Okay. So if someone were to ask me the question, like, why do you do a long call vertical? I typically do a long call vertical on higher price dollar stocks. But if someone said to me, like, what is a higher price dollar stock to you? Probably anything higher than $200. Okay. And if you did that, you're trying to be maybe a little bit more capital efficient, where you're not outlaying so much capital to buy the shares, and you're trying to still get exposure to that move. So stocks like Costco, Netflix, Meta, those stocks probably above 200, for sure 300. Those are kind of more your long call verticals. Now, the second reason, if we went to, let's say, this trade, and let me just bring up what the long call vertical would look like on the option Greeks, okay? So when you do option strategies, what you are really doing is you are trying to focus on certain things. And when we take a look at, for example given like this trade, we want to kind of take a look and kind of say, what are we trying to focus on? So if I look at delta, okay, and I look at theta, and I look at vega, I ask myself a question: which of those option Greeks is the biggest? It's not even close. It's delta, okay? The higher the delta is, the more that we're focusing on what? Time? No. Volatility? No. Twice. We are focusing on direction, okay? So if you're doing a trade where the delta is significantly higher than time in Vega, you are focusing on doing a directional trade. Do not be confused. Now, when you look at this directional trade, you can have directional trades where there is some positive theta. There is. And if you have positive theta, you have short volatility. Now, that volatility, or Vega, is not massively negative, but it is slightly negative, okay? Now, what's a reason why someone, for example, does a vertical? The third point. They like to do a vertical because time, in this case, is somewhat positive, somewhat, but also they're trying to make it where the Vega is more flat, okay? So they don't want to be exposed as much to where volatility goes. Go back. What is this trade really focusing on? Direction, okay? Now, what I want to do is let me kind of show you a little compare and contrast here, okay? Now, when you take a look at IBM, and with our discussion that we just had, we have IBM, we have a long call, okay? Got a long call, and the delta for one contract is 85. Now, we want to look at all these Greeks and ask ourselves, which Greek is the biggest? So if I said second trade here, IBM, the delta is 86, theta is negative 8.7, and the Vega is 10. Now, first off, if you buy an option, you buy a call, you buy a put, Vega positive. So if volatility expands, well, you could benefit. Now, I don't count on that, okay? I don't ever typically think, oh, man, I'm going to buy a call, and I think volatility is going to go up. Or I'm going to buy a put, and I think, well, I would think that more on the put, but probably not on a call. Why is that? Well, because if we buy a call, we think the stock goes up. And if the stock goes up, the volatility tends to fall. So if you buy a put, you might think that volatility might help, okay? So of these three Greeks, we're thinking a delta, theta, Vega. Which one is bigger? By far, it's delta. And when you look at this and say, why don't we like to show a lot of examples of buying calls by themselves? It's an easy answer. Quite a bit in terms of negative theta. Now, this kind of goes back to why the long call vertical. Now, I had a friend who probably on an average day would have negative 400 theta. Ooh. Okay, now it went really well when the market went up. But I remember back in 2005, the market went flat for about 60 days. If you think about a decay of 400-ish a day, and it got higher than that, okay, you could really see that long calls could be dangerous because that is that time decay on those options. So this is another reason why someone likes long call verticals over long calls. Well, because they don't want to have so much negative theta, okay? Now, here's the deal. What's the advantage of the long call then? Well, if we get the direction right, yeah, we can think we're super smart. Yeah, sure. But you better get the direction right, and it better make that move fast, okay? Now, can you always count on that? I can't. Maybe you feel like you can nail it all the time. To me, I think that's somewhat risky, okay? And so a lot of times I don't show a lot of long calls by themselves. That is, if you pick that, you think your timing is impeccable, it's going to make the quick move, and you're going to try to get in and get out. So it tends to be sometimes more of a shorter term type of trade. I'd focus on maybe 2 to 3 weeks, minimum probably 2 to 3 days. Now, what I'm going to do is let's kind of talk about just real quick doing an example. So whether we do a long call, whether we do a long call vertical, whether we do a caller strategy, they're all bullish. So we're always thinking about an uptrend. We're always thinking about price above the 10-day moving average. I want to kind of start with kind of what we talked about to begin with, which is we're looking for a stock that really is maybe a higher price point. Okay. An example given, we're going to look at Tesla. And it's, if I ask you, Michelle, Nora, Thea, Ricebird, let's say I said to you, hey, let's buy 100 shares of stock. And you said, well, geez, James, I mean, if I buy 100 shares of stock, it's $37,000. Some people might not just have $37,000 in their back pocket and they're willing to buy shares right on the spot. Now, don't get me wrong. There's a ton of people with a ton of money, okay? And they were like, I'm going to buy 300 shares. But maybe for the average folk, they're not going to probably buy 100 shares of Tesla, okay, on the spot. So let's say we said, look, we like the direction. I just don't want to have that same capital outlay as shares. And I want to try to potentially gain from that trend. Now, when we do like that long call vertical, what we're going to do is we're going to pick that 20 to 50 days to expiration. Now, the thing is, you got to understand something. When I say 20, 50 days to expiration, we're just trying to get a range. The Decembers are a little short, okay? And the Jans are at 43 days to expiration. And you need to understand something here that we would like at least 20 days so we have some time for the trend to evolve. So we're going to go to, now, by the way, are we against the 27 Decembers that are the weekly options? We are not against them, but we need to verify liquidity. You knew that was coming. Now, if we take a look and said, let's just kind of verify something. If we picked, let's say, the weekly option, non-standard option, not monthly, and said, what's the bid-ask spread? 15 cents. The monthlies are 20. Do they have open interest right here on these? Yeah. What about over here on the call side? Yeah. Okay, you cannot assume. You have to verify. So here's the moral of the story. Do not be lazy in thinking, oh, it's Tesla, it has options. You cannot be lazy. Well, you can, but you might regret it. You want to check the liquidity. We can see liquidity on the bid-ask spread. It should be tighter if there's greater liquidity, higher open interest, and the volume there as well. Now, the one thing that we're going to do is we're going to choose the at-the-money strike. We're going to pick really that 370. Now, if you say, well, James, I like my calls to be a little, maybe one or two strikes in the money, and I don't like the 370 because we hardly have any intrinsic value. Fine. Now, what we're going to do is we're going to right-click on that 2175, buy vertical. Now, I want you to think, let me show you something, okay? This is going to blow your mind, okay? Are you ready for your mind to be blown? And by the way, I couldn't imagine if someone said, no, in 2024, I haven't paid attention to the stock market at all, and I'm not even invested in it. I mean, wow. I don't even know what to say, which for me to be speechless is quite hard. Okay. Now, so let me kind of show something just real quick. And Josh kind of alluded to this before, okay? So I want to kind of show something just real quick. So some of you kind of made a comment regarding the number of new highs that we've had this last year. Number of times the S&P 500 reached all-time highs each year. So literally as of, I believe, this morning or yesterday, we were at 54 new highs. Now, if you notice that right here in late 1990s, we had a year where it was like almost punched 80 times. Now, for some of you that are like 65, you're the luckiest people ever, okay? Because literally in 1980, the S&P 500 was at what level? Answer, 100. And by the way, if you said, what was the housing prices back in 1980? It was a lot lower than it was now, and multiple chances of refi along the way. So for those of you that are mid-60s, 70s, you're probably pretty flush on the balance sheet. You've had some economic tailwinds that have been monstrous. If you say, I didn't really take advantage of it, well, welcome to the trend trading class in 2 hours. Now, the biggest thing is it says that if you take a look at this, this is also the 6th most highs in a year since the 1920s. And the biggest thing is the market has not even seen a correction this year of 10%. The first such occurrence says 2021. Okay. So in the last 100 years, we're talking about 100 years, not 10, 100. So this has been pretty amazing. And you want to ask yourself, how have you participated in that trend? Okay. It ain't knowing about it. It's how much did you make? Okay. That's what your wife wants to know. That's what your husband wants to know. And that is definitely what your kids want to know. How much do we have, parents? That's what they want to know. Now, if we take a look at this, we're going to do a $5 wide strike. We're going to come over here to this debit here, 240. Now, when I look at a typical call spread, long call vertical, I'm always thinking we're probably it's going to be 50-50, okay? If we're have a debit of 250, the risk is going to be 250. That's pretty standard. Now, we're going to right-click on this, analyze the trade. Let me kind of pull this up for just a second, okay? Now, this diagram is a diagram that we've been focusing on quite a bit, okay? Where we have a maximum loss built in, and we have a maximum gain built in as well, given the vertical. Now, let's go back to the question we asked ourselves before. What's the question? Well, we want to ask ourselves the question like, hey, what's the delta? What's the theta? And what's the vega? And if I were to ask you, like, which one of those three is the biggest, we would have to say delta. Now, this is why I've been talking about the collar strategy, which I'm going to show in just a second, okay? If you ask me and said, James, what don't you like? You're entitled to what you don't like, and so am I. Let me tell you what I don't like. I don't like that sometimes the delta is so low. Meaning, if the stock went up $1, okay, the stock investor would be up $100. But if we got in a long call vertical and the stock went up $1, we would be up just $4-ish. Now, I don't know about you, but that kind of leaves a bad taste in my mouth. Like, that's it? The stock investor is up 100, and the long call vertical, while they feel like, oh, I got some money, like only $4? That's it? Now, we'll talk about that in just a second. So a lot of investors, they like this, okay? They have a maximum gain they can make here, but also to some degree, they like that maximum gain, but kind of stinks in the short term, but there's pros and cons of the strategy. So the one thing I want to kind of point out here is a long call vertical, yes, it gives you exposure to the upward trend, your positive delta, but it ain't positive by much. And that's why I've been talking about that collar strategy. We'll do an example of that in just a moment. Now, let's say the investor comes in and says, okay, we're going to do this, okay? We're in the IRA account. We'll reset this account at the beginning of next year, okay? I can't tell you where we started. Maybe your memory suits you well. Now, the biggest thing is we're going to buy, and we're going to kind of think about the position sizing. So if we could risk $1,000, okay, and the risk per contract was $243, all we're going to do is $1,000 is what we're willing to risk, okay? And if we said, calculator, move over. Oh. Okay, sorry, it was hiding from me. $1,000. Let's say we're willing to risk that. Now, by the way, probably going to struggle in your trading if you're not willing to risk something, okay? You're going to be probably late to a lot of trades. We're going to divide that by 243, which is the debit, okay? And when you look at this, it's going to give us 4.11 contracts. We're going to round down to 4 contracts. So I'm going to come back down here, go edit, come down, okay? Plus, now be careful. We do not want to go minus, because if we go minus and this flips to red, we're doing a short call vertical. We don't want a short call vertical. We want a long call vertical, okay? And remember on the diagram, what do we really want? We want that stock to go up above the short strike and both strikes to be in the money, honey, okay? That's what you want. Now, it kind of sounds, it's similar to a covered call, right? And it's similar to a collar strategy. That's where you make the most money, okay? Now, what we're going to do is going to come back. We've got 4 contracts, confirm send. Trade number 1 here, long call vertical on Tesla. So if you kind of said to us, when do you tend to use long call verticals the most? Easy answer, on stocks that are probably higher than $200 to $300, okay? We try to save the capital for stocks that are probably less than $200. Well, because in that case, we could buy those shares, okay, and that money goes farther on stock that are not as high priced. Remember that on this here, it's a non-standard expiration. We got a weekly option. We noted that, but we checked the liquidity. Going to send the order, okay? Now, I want to go back to something for just a second, okay? Now, I want to kind of go back to this trade for just a moment on Love, and I need help on Netflix. I need you, Mike, to tell me, what should I do with Love? I mean, should I make a comment like, oh, I got 15 days left, I don't need to do anything? I mean, is that appropriate? I mean, is that the answer? I got more time? Well, let's double check something real quick. Now, remember, sometimes I want to check the numbers, okay? And what you're now going to notice is we want to take a look at what was this trade price, meaning like what was the debit, and I want to kind of look and see what is the profit relative to the maximum gain. So do not fall into this, oh, I got more time, because you might not have much more to make. So what was the debit on this trade? Now, by the way, this is what you're going to be doing, okay? So if we paid $145 and we collected 17 cents, the debit there was $132, or in other words, $132. So that's what we actually had. That was the debit, okay? Now, what was the spread? Well, it's $5 wide, okay? $5 wide. So if I take $5, the spread minus $1.32, it gives us what the maximum gain would be. $368 per contract. How many contracts do we have? 8. Okay? Now we're going to take that number times it by 8. And this is going to tell us on the 8 contracts, what would those gains be? And survey says, by the way, this is the fun part, okay? 368 times 8. So it says that, hey, James, the most we can make on these 8 contracts is $29.44. Now, this is the question that you always want to know. Where am I on that maximum gain? Well, we got $13.48, okay? Now, a lot of times as investors will say, ooh, I'd like to take that gain and stuff it in my pocket. You know, I like to go buy something or go on vacation. Well, I mean, I'm not sure if we're going to go there. But what I want to do is I want to kind of look and see what percentage of that do we have. 1344 divided into 2944, we're sitting at 45.65%. Tell me what to do. We just take the money and run? Should we? Tell me what you're feeling, okay? I'm trying to stroke your emotions here. I'm trying to get you to bite on emotion. Now, sometimes that's not the right answer. You might be saying back to me, but I like emotion. It just feels good. Okay? Well, here's the deal. We always talk about the 50% in the first 10 days. This trade's been on longer than 10 days. Okay? We go back to this for a sec. We go back. It's been on since the 11th. So we can't say 50% in 10 days. It's been longer than 10 days. 65 with 20 days or more. Okay? Days remaining or 80% ever. We're not in any of them. So why would the investor just point blank sell? Well, they might point blank sell if they think that stock is kind of more at the target. So this now kind of goes into the question. Do we think we're at the target? Do we? Okay. If I ask you, are William, David, Ray, Paul, I mean, where's the target? Well, you're talking to a person that maybe looks at channels. And if we kind of look at this old channel, that old channel was about $3. And if we add that $3 to the top, that's going to get us right to about, okay, right there. Okay, now, so if we kind of said in this case, do we think we're at the target yet? My gosh. Well, that target, if we kind of measure the channel, add the channel width on top of the resistance, it's going to give us about 37.78. This morning, we got to a high of 36.12. Could it have been impossible that someone could have been near the target? Yes. Now, let's go back to this. So if the investor said, look, I understand about the percentages, 50% in the first 10 days, 65% with 10 days or 20 days or more, 80% ever, fine. But James, I have a target. I'm using my technicals with the options, and we're going to go market day GTC, and we're going to go over here to the right. And what we're going to do is we're going to put that target, I'm not talking about target here, okay, like super target, okay? We're going to say, look, love, if you get at or above, I'm going to type in a number of 36 and a half. So if we go to 36 and a half, we think that we're in that short-term target here to sell, sell, sell. Now, wait. Wonder if we only get 58% of the maximum gain. Yeah, fine, right? You're not always going to get the 100%. The only way you get the 100% is you go all the way to the expiration. And the stock closes above both strikes. So I know we like the 100% number, but that involves the stock goes up massively, or you got to hold all the way to expiration. Wonder if you want to grab a chunk of that prior to the expiration. That means you might not get it all, like this example. Now, what we're going to do is we're going to say sell this position if the stock price gets at or above 36.5. Fine. Save, confirm send, fire in the hole. Bang. Now, here's what we're going to do in this case. A little fun here, okay? So I don't want you to think when you talk about trading, investing, that it's going to be like guys, let's turn to page 14 and let's look at what the MACD means. That's not really how we like to teach, okay? And Mike and I we like to have a little fun here. Now, here's the deal. So on love, now quickly on this, I just want to kind of look and see where we at on Netflix. And then we're going to talk about some new positions. So more quickly on this one, I'm just going to kind of take a look and see what do we have here, okay? Now, if I take a look at this, we paid $28.40. We collected $26. So in this case, what is that? You pay that. What is that debit there? What is that? What is that? $2.40? Are you with me on that? Tell me if you got that. Okay, you paid $28.40 and you collected $26. That still means you paid out $26.40. Now remember, how many contracts? Well, it's over 4 contracts. Okay. Now remember, if you got a $5 wide spread, $5, okay, and you said, okay, $5 minus $2.40, the max gain per contract, just the difference, $2.60. Okay, so why do we care? Well, I want to know if we got $2.60, okay, and we got 4 contracts, the max gain should be right at, tell me if my numbers are wrong, $1,040. This is if we made absolutely every bit of it, you got everything. $1,040 pre-commission. Now, we want to kind of ask ourselves, well, where are we at right now? Well, if I look at where we are right now and it's moving on us, we got a 840 of, and it's moving on us, of the 1,040. Tell me what to do. Kind of go through your mental check. Okay, so has the trade been longer than 10 days? Let's say it has. 65% with more than 20 days remaining. It has 15 days left, so that doesn't apply right now. 80% ever. Well, we run that math, 840 divided by 1040. By the way, we're at 890 now. It's moving on us. 890 divided by 1040, we are at 85%. So on the example of Netflix, it's giving us the option to say, would you consider in taking the money? Beep, beep, beep. Would you back up and say, you know what? I would like to put these profits in the trailer, so to say, and just take it and move on, or take it and roll the position. Well, so how do you close them down? Okay, simple. Now, the first thing is just because so what I'm going to do is I'm going to hold the shift key down on my keyboard. Then we're going to click on the next line too, while holding the shift key down. It just highlights both those lines. Then we're going to right click and say create the rolling order, or excuse me, create the closing order. And we're going to go ahead and go sell. Now, if I go sell, notice we got in for a debit and we're getting out for a credit. And what we're going to do is we're going to say, look, we're willing to give some of that. We want to try to get out and capture this $870. Not just because I put my order in doesn't mean it's going to get filled, okay? But we're going to see. Now, what I'm going to do is confirm and send. And now what I'm going to do is when I get out, there is also a commission. Now, let's kind of speak to that real quick. Let's say we paid $520 to get in, $520 to get out, okay? So when you look at the other things, maybe a bad part about verticals is commissions. The commissions here was $10.40, and if we can get out of here for $860 gross gain, how much of those gains were chewed up by really by the commissions? 1.2% of the gross profit was really eaten by the commission. So that's leaving in this example 98.8% net gain, 1.2% went to commission. I mean, okay, that's what it is. Okay. Now, I think that's important to kind of consider. So the other thing is when you do, let's say verticals, you want to kind of make sure, that's what we talk about. Are the returns big enough potentially? Okay. You want to kind of think about how much of the commissions relative to the potential gains. If the credits or debits are not, if the maximum gains are not big enough, you might not consider a vertical type strategy. They are more commission intensive. Okay. Now, we're going to go ahead and try to send this order. Okay. And it filled for $460. Now, do the seller get commission? Now the comment, now just real quick to say, I'm not really sure on your question. They're really getting the price. Okay, so let's say you so someone bought the stock, sold the stock, right? What does the seller of the stock get? The seller of the stock is getting the price. Okay, the buyer of the stock is getting this. They're paying the commission. Okay, they're paying for the stock. We're talking about stock. But with that is they're buying the stock and they're paying the commission, okay? And really the seller's trying to get a higher price, but they're also paying a commission as well. Both, we're talking about stock, both are paying a commission, okay? Now, the one thing is if you've been around the market for a while, there's been a drastic change in commissions. And many investors might like it, but it doesn't mean that there's no commissions. That's why we just kind of want to focus on it for just a moment. Now, I want to go back to a position for just a second, okay? Now, I want to kind of go back to the example of Meta here, and I'm going to go back and let me kind of pick maybe even a different stock. Let me kind of use the example given of PLTR, okay? Now, what I want to do on this is I want to kind of show you something a little different, but I think when you compare and contrast a strategy that's similar, it's going to be long call vertical like, but there's going to be some differences. Okay, but the diagram looks very similar. So wonder if you said, James, I like a long call vertical, but I really related to that point that maximum gain really wasn't that big, or the delta really wasn't that big. Okay. Well, let's kind of show something. Let's say the investor said, James, I see an upward trend on a stock like PLTR. I'm going to come to the trade tab for just a moment. And step number one we're going to do is we're going to buy the shares of the stock. They ain't a long call vertical, you buying shares of stock. Now, but we're going to kind of like vertical it, okay, as you'll see here in just a moment. Now, what you're going to notice is we're going to buy the shares of the stock. Now, remember what I said before. Let's say if that stock is below $200, we're going to buy the shares of stock if we wanted to. Okay, we're going to buy those shares of stock, 100 shares. And then step two, we're going to come down to where it says single order. First triggers SEQ. And what you're going to now notice is we're going to go look at 20 to 50 days to expiration and try to sell a call with a delta of 30 to 40. So it's just out of the money. Okay, out of the money. Why the delta of 30 to 40? Well, we want there to be some upside on the stock. Okay, fine. We're going to go ahead and sell that 76. That's the first one we see in that strike zone. And we're going to click on that. Okay, so there it is. Now, by the way, if you saw 231 bid, 240, 241 ask, would you just hunky-dory, just take the 231? Nah, you're probably going to say, look, don't run through these. I'm going to try to get maybe somewhere in the middle here, okay? And the same thing on the put. We're going to come over here to the put side, and we're going to try to do maybe something like over here where we buy a put. And in this example, what I'm going to show is I'm going to buy a put with a delta 30 to 40, same as the call side, and I'm going to buy the 68 by just clicking on the ask price. Now, what you're now going to see is this is maybe a little different, okay? And you're going to see that we have an obligation to sell the shares at 76. We have a right to sell the shares at 68. Now, if you say, James, I like long call verticals, I like short put verticals, but I feel like I'm just making pennies on the dollar. I mean, the market is at 54 new highs, and I'm literally making fractions of dollars when I could have maybe been making a bigger amount of dollars. Well, let's speak to you, because I don't want you to feel like that. That'd be horrible, okay? Now, the biggest thing is I'm going to kind of just put this on the Analyze tab. And one of the things that some investors like is they say, James, I still have this maximum gain, okay? I still have this maximum loss, okay? Now, note it here. Why is the delta of this position, why is it bigger? Why is it bigger? So we got delta 30. We got theta of 158's positive theta, and the Vegas flat. So if we said, hey, like, what is this strategy really trying to do? Well, if you have a higher delta, you are focusing on direction, okay? The theta and the Vega are almost non-factors. So you are trying to pick a direction because you think your technical analysis is superior among all others. Right, Chris? Right, Mark? Don't act like that's not true. Okay, so here's the deal. Why is the delta bigger? Easy answer, because you bought the shares. Okay, now, so let's go back to the little sheet that we looked at the other day. So, and kind of look at the maximum gain, maximum loss. So how many of you have ever done a long call vertical? Be honest with me. Be honest. And if you're not honest, it's going to hurt my feelings. How many of you ever said, yeah, James, I made that gain on that long call vertical, but kind of had hard feelings that I didn't make more? How many of you have ever thought that besides Bill Barnhoff? Okay. Now, what I'm going to do for just a moment, okay, I'm going to kind of type those numbers in. Stock entry price, okay, 71.77. Okay. What's the short call? Short call is $76. What's the long put? Long put down there, $68. Okay, now we just kind of want to see, wonder if it goes up, wonder if it goes down, and so on, okay, or wonder if it goes sideways. So from 71.77 up to 76, the stock appreciation is 423. Okay, it's not super hard math, that's just what it is. Did we get a credit or debit? Well, you're going to see that if we collect 235, we pay 206, we have a credit or debit. We got a credit of 29 cents, okay? So the stock appreciation is 423, but the credit, 29 cents. So if you add those two up, 452. So that's the maximum gain, which, by the way, that's not a bad maximum gain. 452 on a $77 stock, ladies and gentlemen, boys and girls. Guys, that's I mean, how greedy can someone be? You're thinking, James, I'd like to find out. Well, let me pull you back from the cliff here. So here's the deal. That's like a 6.3%. If you make 452, that's 6.3% in like 22 trading days. Okay, but what if the stock goes down? Well, you got the right to sell those shares at 68. That's like that firm line. It's not a stop. This is not a trigger to sell. You got the right to sell. And now you're going to see that if we go from 71.77 down to 68, stock loss defined at 377, and you got the credit there, so that's going to offset a little bit, and that loss is 348. So the parameters of the trade is make 452 maximum pre-commission, and potential maximum loss 348 pre-commission. So when I think about a caller strategy where you're just doing it all at once, buy the share, sell the call, buy the put, it's very vertical-like. But the delta is drastically higher. So if we kind of saw a typical long call vertical, typical one, well, you probably only have 5 or 10 delta typically per contract. But if we said, James, these shares are lower than $200 on shares that are below $200, I like to, for example, buy shares of the stock. Well, we could probably triple, maybe 5-6 times what the delta would be on a typical long call vertical by just doing the caller strategy, where the numbers are going to be very vertical-like. Now, wait, stop. Do you still get a dividend if it pays the dividend? Yeah, it could be paid too. Okay? Stock appreciation plus the dividend. We ain't even including the dividend if it has one. So the reason why I kind of interject this here, you might think, well, this is so off base. It's not, because it's kind of taking some of the negative of a long call vertical. The max gain isn't a ton and the delta is really small. You might say, I'm going to do like a caller type strategy on maybe stocks that are lower than $200, still kind of have that one-to-one reward to risk. Here, the reward is better than a one-to-one, okay? But it's still defining the risk to the downside. Hey, and so here's the deal. Many of you investors out there, you've already bought stocks before. And when you say, well, where could I maybe learn options, but at a controlled max loss, max gain scenario, it is a caller, okay? Now, I'll talk about more of those examples in about an hour from now. But I think this is appropriate to kind of bring up this diagram and kind of relate back to, how does it compare to a long call? How does it compare to a long call vertical? Why would someone do a caller strategy? And they're even thinking in their mind, I like long call verticals, but I just want to pump up that delta to try to make a bigger gain, okay, if it were to go to the upside and still have that maximum loss built in. Now, I'm telling you, sometime during the day, this is going to hit you right between the eyes. You're going to say, my gosh, why didn't I do this before? Well, that's how I always felt. Many times the light came on and I said, I get it now. Okay. So if you like a long call vertical, start there. If you say, I do long call verticals, but I want to amp up the delta, you might say, I'm going to do the caller. Okay. Very similar, but slight differences. Now, I'm out of my time here today, but we did some kind of examples and some discussion there. And let's go ahead and send this through. Now, remember, on this example, we also chose a weekly option. Now, when I looked at that bid-ask spread there, they were pretty tight, and the open interest was there as well. Notice on the commission there, 65 cents for selling the call and 65 cents for buying the put. And if you take a look at this, you're going to see that there's not a commission to buy the shares explicitly. There's implicit costs, and that's really in the spread. Now, what you're going to see is we're going to go ahead and send that back, and we're going to see if we can't get filled there. Now, your homework assignment, I want you to go out and do 2 long call verticals, but I want you to also side by side practice doing a caller as well, where you buy the share, sell the call, and buy the put at the same time. And I want you to kind of compare those two. And I think when you compare like that, you really kind of start to say, I get it now. I get it maybe why I would do one versus the other. All right. Now, the goal from this class is next week when Ben comes back to teach that you would show up for his class. Hopefully I didn't blow any of you out here today. All right, a little fun there. Now, remember that coming up right at the top of the hour, let's go back to just real quick, show this. Now, remember, if you're not following Mike and I on X, make sure that you do so. I want to kind of give us a quick reminder that coming up next, if you go to YouTube, you're going to see that we have a page that will show what's the next up and coming class. Stay tuned for that. And also, you're going to see that we have a live, and you're going to see that coming up, if you go to live, you're going to see that we have the next up and coming videos as well. So stay tuned for that. Subscribe if you have not done so already. Now, I'm out of my time here. Remember that with what we discussed, it was done for example illustrative purposes only. I'm telling you that every time you come to these classes, it's going to penetrate your mind more and more and more and more and more. And then you're going to wake up one day and say, I get it. Now I'm dangerous. Okay. Now I actually know what I'm doing. And that's when it gets fun. Okay. Because now you're kind of past that just initial learning. And now you're saying, let me show you something. And that's where I love to hear that. Now, remember with what we discussed, it was done for example illustrative purposes only. Stay tuned for our next webcast coming up at the top of the hour. I'll be back at 1 p.m. Eastern on Trading the Trend. This has been the class on long verticals here today with a compared to long calls and callers. Take care. Stay tuned for our next class. Thank you, Michael Fairborn, and see you back at the 1 p.m. Eastern. Take care. Bye-bye.